Hey guys, and welcome back to another video. In today's video, I'm going to be trying to put some perspective on the bond market going into 2025. Before we go ahead and get started, however, I'd love to hear your thoughts in the comments section down below. So pause the video and share your thoughts down there. Now, honestly, I think there's been a little bit of an overreaction in terms of the downfall of bonds. Let's go ahead and talk about just how crazy these last couple years have really been. Starting with the shutdown in 2020, you can see the reaction to this in terms of the bond market was not really how it normally works. Now, one of the biggest reasons why this happened is because investors didn't pour into treasuries like they normally do. If you go ahead and look back at previous crashes, investors were much more interested in buying treasuries. Instead, they showed a little bit less interest, and this caused the actual Fed to have to go in and purchase them to keep the prices and the yields reasonable. Now, in my opinion, part of the reason for this was the fact that the market itself was actually doing really well, even if the conditions that the market existed in were super uncertain. You can see going back to 2020, in a year where a global pandemic hit, the market still returned 16%, and in the year after, closer to 30%. Now, while all of this was going on, of course, we also had stocks like GameStop going up 3,000+% in a month. We had crypto going crazy. We had so many bizarre market conditions that I think a lot of potential bond investors felt like they could be missing out on much higher gains. But honestly, the stock market back then was almost like gambling. You never knew what was going to go up a ton or down a ton in a day. It was being controlled by Reddit forums. It was truly chaos, and I don't think the Fed quite expected that. Then if we fast forward 2 years, we had the absolute boom of the I bond returning almost 10% for a while. Now I'll tell you, that is a lot for a bond return. People poured into those, and for good reason. Now, obviously, this 9% didn't last forever. It dropped down a whole bunch, and by 2024, the majority of investors were selling their I bonds in favors of things like treasuries. We can see at this time, however, that the rates on treasuries were extremely high, keeping in mind that there was even an inverse yield, meaning that the shorter term treasuries, like the 4-week or the 13-week, were producing much higher yields than the 10-year or the 30-year, which again is not normal. For example, when we go ahead and have a look at 4-week Treasury bill yields, these peaked up towards 6%. That is crazy, especially when you consider that chart I just showed you with the 10-year never going over 5%. Now here comes our first introduction of a little bit of current perspective. However, let's go ahead and have a look at the left side of this chart showing 2022 when T-bills were returning under 0.5%. Obviously, if you were heavily invested in these and enjoying almost 6% yields, it can be disappointing that they've now dropped closer to 4 or 4.5%. However, this is a whole heck of a lot better than sub 1% returns. So let's keep in mind that the end of T-bills and treasuries and bond investing in general is definitely not here in 2025. Now, what exactly is going to happen with bond investing going into 2025? That is extremely unpredictable. Now, in December, the Fed cut rates for the third time this year, this time for 0.25%, and also updated guidance saying they expect just 2 interest rate cuts in the upcoming year, which is the year we're now in, 2025. In addition to that, you can see they said that their estimated and desired 2% inflation goal is not going to be hit until 2026. Now, all of this comes at a time when Bloomberg, along with the rest of us disregarding bond investing, would have wanted the inflation to sort of calm down and these rate cuts to become more acceptable. You can see even the Fed themselves is somewhat divided in this one. Powell said that the decision to make the cut this go around wasn't even unanimous, calling it a closer call than other decisions, and they raised their inflation outlook for the year up to 2.5% from 2.1%. Now, the sort of cherry on top to all of this, and one of the more obvious components to uncertainty in 2025, is an incoming president. With a new president as well as a new Senate and House members, there's going to be a lot of policy change. How that will affect things exactly, we won't know until later. However, it adds a lot of uncertainty for bond market investors. I think these last couple paragraphs here are really important for a couple reasons. Number one, it sort of states that inflation is not going to get tackled immediately, regardless of how successful or unsuccessful policies that are soon to be implemented actually are. And lastly, it states that the 10-year Treasury yield will likely stay between 3.25 and 5%, meaning that bond investing is going nowhere. Now, before we go ahead and wrap up today's video, I just want to show two more graphs to give us a little bit of perspective of where we're really at. This first one is the 10-year Treasury yield sitting above 4% at right around 4.5%. When we go ahead and look at previous years, this is still the highest yield that we've had by far since at least 2013. Now, obviously, I'm excluding our little peak here in October of 2023, but when we're talking about the environment of the bond market prior to our current situation, it really is incredible how high these yields still are. Now, I haven't talked a lot about corporate bonds specifically with this because a lot of the same factors factor in with corporate bonds in the same way that they do with treasuries. However, here's a graph showing us our 10-year high quality market corporate bonds yields. And again, we can see when we exclude that spike in October 2023 and we talk about these years prior to the pandemic, our yields on corporate bonds are still extremely high. I hope you went on to enjoy today's video and it put into perspective where we are in terms of the bond market going into 2025 and beyond. If you have any questions or thoughts, throw them in the comments section down below. Hit that subscribe button if you enjoyed the video. But other than that, we'll see you in the next one.